Welcome back to the Underwriting Intelligence Podcast. I'm Amrit and I'm your host. Today, I'm delighted to be joined by Andrew McMellin, President of Markel International. So, Andrew, look, I think, lots of people are going to know about your background and history already. I'd love to hear a little bit from you, I suppose, about your career. And the kind of, I suppose, if you could describe kind of the characteristic moments in the journey that you've been on, just to give a little bit of colour to the journey you've been on and how you became the president of Markel International today.
It's interesting. I've been in the industry about 38 years now. I've been fortunate to be a broker. I've been an underwriter. I've worked at an MGA, worked in London, and also worked overseas in the US as well. If I think about seminal moments, definitely when I first started in the industry with what is now actually called Willis, I started off life as on the client account side, and then got the opportunity to come up into the Lloyd's and London market. And I can remember this day, walking into that Lloyd's market when at the time there was about 400 different syndicates. So a very different environment to what is today. But just literally walking those kind of almost hallowed floors of 400 years of history was a real seminal moment. And then 7 years later, transitioning through to become an underwriter and sitting down in a Lloyd's box and having to, in those days, you were putting stamps down as you took the first risk. And so again, just a complete change from broking to actually taking the risk on board. And then, moving on, going from underwriting into underwriting management and realizing that I was now being asked to sort of oversee different books of business which I didn't have a knowledge of, and so just thinking about how you shift and start to be able to ask questions of people so that you can understand what they're trying to do, what their strategies are, even though that they know more about that class of business than you do. And then I guess another key moment is when I went over to the States and went to work in the US, and you kind of go out of your comfort zone of that sort of London Lloyd's market, which I've been in for a couple of decades, to then go and learn a new market. And the US is obviously a very different market, the largest insurance market in the world, but set up very differently. And then fast forward, I joined Markel 4 years ago now, to run the London market and Asia Pacific business, and then took on the president of International in May last year. So some real key moments through my career to date.
That's super cool. And, it's interesting for me, we've been, as HX has been expanding into the US, learning the kind of idiosyncrasies of the US market is something fascinating, right? I think if you work in London and you're so used to, particularly if you work in the commercial space, just like the very rich, flexible way it's priced and underwritten. And then you actually find out when you go, out to the States that $1 trillion of the world's insurance premium actually works in a completely different way, right? And I think, all of those different experiences must have set you up, working for Markel US. Obviously, you're part of the international business, but, a variety of portfolios fitting together in lots of different ways with capacity deployed in different ways too.
Well, and dynamics in terms of between, in the US, you've got the excess and surplus lines market, which is sort of freer form and rate. And then you've got the admitted market, which is much more regulated, but regulated by state. So you've got sort of 50 different regulators to deal with. And then how you deal with the data and the underwriting in those different areas is slightly different. I mean, there are also commonalities around portfolio management, but access to data can differ. The emitted data is there. You can get access to it a lot more readily to help inform your own decisions, whereas the excess and surplus lines are a little bit more specialist and so less available. But it all comes down to making good underwriting decisions and thinking about how you set up your portfolios and how you kind of think about moving through the different cycles and what levers you're pulling as you go through that to make a sustainable, profitable business over time.
Yeah, and that's a lovely segue actually to the first question I wanted to ask you about portfolio underwriting. So I was thinking about this as I was preparing for this show, because one of the first times I ever worked on portfolio underwriting was back in the day at Catlin, and when I was talking to you about actually the approach to portfolio underwriting. And so, you've been doing this sort of taking this approach since the kind of late 2000s, which is kind of terrifying to me, is nearly 20 years ago now, when I first started walking the halls of Lloyd's. And it's now a very popular concept. And how do you think about portfolio underwriting, and particularly kind of in the approach to, how you kind of guide and set your team's approach to that?
To me, I mean, the portfolio underwriting approach is really sort of taking a step back and looking at the bigger picture rather than individual risk underwriting. I mean, individual risk underwriting is important, and you're making judgments on those individual risks. But actually, portfolio underwriting is thinking about how do those individual risks add up, and what do they add to the portfolio, or perhaps what do they detract? Does it improve your portfolio over time, or does it have a little bit of a negative impact? And then thinking about the dynamics of the portfolio. And I think one of the things that we ingrain into our underwriters and have our international portfolio analytics team help is recognize that in any given portfolio you've got different segments, and those different segments behave differently. Some will be very, very uber profitable, and you got to think about how do you kind of grow and increase those. And at any given time, there'll probably be segments in that portfolio that are not doing so well, and you think about what do you need to do to improve those. But overall, it's kind of how the overall portfolio runs, and that's going to produce the profitability over time. And then you can overlay that into commercial aspects. So how do individual broker portfolios run that you have, and what decisions are you going to make when a broker comes and says, I need you to help me, or I need you to underwrite this risk, and you've got to there take a step back and look at the individual risk, but then think, okay, well, commerciality is that, how does that portfolio for that particular broker, or even it might be portfolios from clients in many different risks. How do I view that and view this risk adding to that? And I might make a different decision thinking about the overall portfolio profitability than I might if looking at the individual risk. And so we spend quite a lot of time with our underwriters going through that portfolio management. I say we've invested very heavily in our international portfolio analytics team. We've quadrupled it in size over the last 4 years, and that's made up of not just portfolio managers but data analytics, in terms of pricing model builders, all of which are there to help the underwriters and help them determine how they're going to manage their portfolios over time and make them sustainable across time. And I think that's where over the last 20, 30 plus years, the market has moved more to think about that. And it's got better tools to be able to do that as well. And we're still adding to those tools and investing in those tools, every day, every week, every month, to help make those profitable decisions.
Yeah, it's so interesting, isn't it? Your point about the way the market has moved this way is so true. And I think I think one of the things I'm really interested in is the kind of interaction between the underwriters and the actuaries and the supporting teams. Because I think one of the things that I felt early in my career is how important it is to understand the kind of context that the underwriters have when they're approaching a risk, right? Which is more than just the kind of individual rate adequacy of that risk. I think early on in my career as an actuary, you can become quite like divorced from the reality of the commercial needs to balance a portfolio. Because you do some pricing, some case pricing, you see one risk. It's very easy to say, oh well, this one looks good, and just yes to all the good ones, and make an underwriter's like very difficult. It's like, oh, 90% rate adequate, not sure about that. When an underwriter actually has to balance the whole portfolio. So I'm really interested in how you've kind of imbued that kind of team mindset and created a kind of culture where actually everyone can understand that the individual decision isn't what's going to help the team win.
Yeah, well, it's taking the underwriting teams through how their portfolio is made up. So looking at, profitability is one measure, looking at volatility is another measure. And to that, looking at line sizes and sort of showing them how if their average line size across a portfolio as an example, and how if they write a particular number of risks at a certain line size, what that does to the dynamic of the portfolio. How if they add a whole load of risks at the maximum line size, what that does to the overall portfolio, as opposed to writing a whole load of risks at the average line size. And you can take them through different scenarios, and they can sort of see how pulling those levers impacts the overall volatility and profitability of that portfolio. And you can help them work out that, okay, by changing a business mix on a particular portfolio, you can impact the underwrite the loss ratio one way or the other, impact the aggregate and the volatility a different way. And so it's really just kind of making them think about how all the different dynamics add up to a more holistic view that they need to be taking across their whole portfolio. And it's also getting them to understand that this is adding to the judgments that they make, and it's a useful sort of insight, a useful way to help them think about underwriting in a more holistic fashion.
Yeah, it's that's a nice way to frame it, right? Adding an extra tool in their armory to think a little bit about how they can get to the ultimately the result they need. Maybe we can jump to something that's similarly become more popular recently, which is that of the kind of data-driven technical underwriting side of things. So obviously we're seeing a huge efflorescence of smart follow and algorithmic syndicates in the market, but even going one level up from that, there's very clearly just much more technical skill being applied to underwriting, whether it's actuarially supported or from underwriters more generally. I find it really interesting because I think this has been like a really important concept in retail for a long time. But it's made its way into the specialty and commercial markets. Again, places we've worked in the past using this for, more than 20 years ago. But it can be quite polarizing. Right. I've had my fair share of interesting discussions with underwriters and brokers on technical pricing in my life. And I'm really interested, you as an underwriter yourself, like how you think a little bit about this and like getting why it might be divisive and how we can get people to engage with the technical data driven, as well as the really important judgments that are so important in the commercial and specialty markets too.
Yeah. And I think to preface it, and I'll go into a bit more detail. I think, we should view data as how it enhances the underwriting. Again, data is another tool that is at the hand of the underwriters to help them make those judgments. But just taking a step back, and we mentioned retail. When I think about retail, and particularly when I think about, let's take personal lines, motor as an example, there is a huge amount of data out there, which has been for decades and decades, but also it can be quite a homogenous class. And so that data can really drive, the insights just purely by the data alone, because there is just so much of it. As we go into the specialty classes, part of the reason that classes are specialty is because there is just a lot less data. It's a smaller market. It has its sort of nuances which the data doesn't necessarily show up, and you're having to use underwriting judgment and experience and in a different fashion. And I think, perhaps some of the polarization is people thinking it's one way or the other. And I think, no, it's an enhancement of both. So as we sit here in specialty underwriting, it's thinking about what data is out there that can actually enhance the judgment and the decision I'm making. It's not going to take the decision away from me because there isn't enough data and there isn't clarity of that data to be able to do that. But it can certainly help test my assumptions, my intuition. Might be my experience might take me one way, but data might actually get me to question whether those assumptions have been right over time, and actually, whether that makes me, go into a different way. I think again, where people get worried is when they say, well, I'm writing this big complex risk, and the pricing model, it doesn't fit into the pricing model. And we shouldn't probably be surprised about that, because pricing models do have limitations in specialty and have lots of assumptions around it. And we can't force every risk into a pricing model, but we can utilize pricing models and data to help us inform our decision. And I think that's where we want underwriters to get to, is, think about the data to help inform your decision. Think about what data is out there, and particularly with access to what's on the internet these days, and there's so much more different data sources that you can bring in to help challenge your assumptions or help drive those decisions. And so from a specialty standpoint, it shouldn't be a computer says yes or no. A computer is there sitting alongside you. You're still going to say the yes or no as the underwriter, but if you can utilize that data, you can utilize that model to help inform it, then you're in a better position for that. And as you build more of your own sort of data-driven judgments, you can actually then sort of tweak the models because you're bringing in your own experience into it and your own intuition into it, and that's what you can utilize over time to tweak those models and change those assumptions. And so I think when we look at our underwriting teams who are building models, we're constantly asking them to on a regular basis review the assumptions. Has the data you've got in the last 6 or 12 months made you sort of change some of those assumptions? That then informs how you're going to think about business going forward. But the models are only ever there as a tool. The underwriter is making the judgment, not the actual pricing model.
Yeah, we think about this a huge amount at HX because obviously we build technology to support underwriting, and I think one of the words I obsess about is like when we think about technology, something underwriting, you've like technology assisted, technology supported. You use words like technology driven, and it can create like a very interesting like divide between the users and the providers of technology. And our goals, I'm an actuary, I've worked in the markets, right? There are many times I've actually had some really interesting engagements in my life where I actually had people rely too much on the models. And I was like, hold on a minute. I always used to make the joke, you give me 5 data points, I can give you any answer you want. And it was just like actually having a situation where it's like a happy, like the combination of the technology, the data, the actuarial underwriter is better, right, is the end goal. And so much comes in that framing and that way you said, like, it's nothing's being taken away. We only want to give you more tools to do your job is like a very powerful framing, I think.
Yeah, and you think about, let's take CAT models as an example. We know that the CAT models and the proprietary firms out there, they're revising them constantly as they get more data. Because they all recognize there's a lot of assumptions in here. As we find out more data that might challenge those assumptions, we should change those models. And some firms will take those models and change them anyway, because they'll say, well, actually, we don't intuitively agree with some of the assumptions because our experience is suggesting otherwise. And so I think that's the right way. It's thinking about those models as they're a tool, but you should challenge the assumptions and understand them, and don't just necessarily blindly follow what they say, because the next version comes out, it's different again, and making that change because they're utilizing the data to inform and enable how the model works.
Absolutely. I think there's a very related theme here with respect to AI, which is to some extent the kind of latest incarnation of the transformative technology, right? That the whole market is wrestling with. So Markel have got off to a very quick start on bringing AI to production. I remember when I spoke to you even a few months ago, there were things and tools that the team had built internally and externally that were already driving value. So I suppose I'm really interested as a leader, what you've learned about bringing technology and AI-based technology into underwriting without diluting some of that craft and judgment that I think, as you said, really does define great underwriting. Have you seen areas where there's more value add and areas where actually you're like, we're not quite there yet?
Oh, definitely. One of the things that we talk to people is how does AI amplify your judgment, not replace it? A lot of the AI we're utilizing in our underwriting and claims processing is all around how we kind of get data that sort of scrape data into our systems. So it's really very much around the sort of data extraction side of things, and that's working well. Whether it be values for sort of our terrorism business, whether it be kind of how we get information off electronic slips into our systems and that sort of thing. We are starting to take it further and move it more into the sort of direct kind of underwriting side of things. We're doing that in a number of different ways. One is thinking about how we use the data to go off and search wordings, big documents, to be able to then supply the underwriter with the pertinent information without the underwriter having to search through that. So we're using Harvey AI, for instance, in our W&I book. It's our warranty indemnity, sort of transactional liability book of business. And we can utilize it to go and search through, huge documents of data. And by creating the right prompts, the underwriters can distill that information. And we found that it's actually allowed us to access segments of the market that we wouldn't otherwise ordinarily be able to underwrite efficiently. And that's, brought in, we've sort of in the last 12 months, probably written $30 million of business that we otherwise would just not be able to write. And it's increased our productivity about 300%. So that's one example where, again, we're utilizing it to help the underwriters make the decision. The AI doesn't make the decision. It just supplies the underwriter with the data in a very efficient fashion that the underwriter can then make the underwriting decision with it. We have in some of our SME business, which are tried in at the moment in Europe, using AI to get access to clients that haven't, and brokers that haven't had access to Markel before. So we've launched a product called Markel Prime in Europe. It's been going for 6 months. It utilizes AI to effectively scrape publicly available data off the internet, harness it with our pricing tools, and in say an area like miscellaneous PI, we can use that information, harness it with the pricing tools, and actually then send out a quote to new brokers and clients and say, we think we like your business from what we know of it. Here's a product that we think is useful for you. We're Markel and we would like to transact with you. And in the space of 6 months, that's given us access to 500 new brokers. 8,000. We put out 8,000 quotes. So that's 8,000 potential new clients are looking at us now. The conversion rate, won't be the 100% clearly, but that's just a way of getting access to customers and brokers that haven't ordinarily had access to Markel at the SME level. Clearly we're in the more specialty area. We're utilizing the AI just to help the underwriters, with the information piece. And the other way we're also utilizing AI, and I think we're one of the first insurance companies to give access to the whole company actually to Microsoft 365 Copilot. And so underwriters can then go off and utilize the prompts themselves, and particularly from a processing standpoint, think about how they can kind of do some of those processes utilizing Copilot. And we've seen some great experimental work that the underwriters and our claims folk and our processing and support functions have been able to utilize that to smooth the process and make things more efficient. But it is all about sort of enabling the underwriting as opposed to taking it over.
That's a really awesome set of examples, because you can think it's almost, there's like the profitability side of things. There's and I suppose the Markel Prime one, which is the one so interesting to me, is like proactive rather than reactive use of AI, right? The idea that you can do market research and segmentation, that's a real unlock.
But bear in mind, the underwriters, so the pricing model is still being created by the underwriters. It's just utilizing, it's effectively just taking, data and filling in a kind of prop form, linking it with the pricing model and saying, right, the price for €1 million of miscellaneous PI is X, and pushing it out there. It's pushing information out to new clients and brokers, rather than waiting for them to come to us.
Yeah, which I think is always, in the markets that we're in, service remains just an incredibly principal differentiator, right? So if you can leverage AI to bring a proactive service to clients, like that's an edge, right? That's very cool, very, very interesting. Awesome. So maybe then, before we wrap up, I'm super. We talked about 2026. It's already here. And you've built a modern multidisciplinary underwriting culture, right? And I think there's not that much doubt that the market's transitioning. So I'm super interested to hear, I suppose, maybe taking a positive spin on it. You know, if you think about the last market cycle and the point where it was transitioning and this market cycle, like where you think the new skills that you and the team have got, and I suppose how you think about the future of underwriting and where you see the breakthroughs, whether it's technology, human capability, or even market structure. We talked Markel Prime, I suppose, is one example, but there's probably many others out there that you can think of.
Yeah, I mean, that's quite a wide net. I mean, what's kind of interesting is I think of what if you think about what insurance brings, it brings certainty to our clients who are facing a lot of uncertainty. In fact, if anything, you could argue the uncertainty is almost increasing day by day, and I think insurance therefore is becoming even more important. I think the other area that we need to evolve on though is actually a lot of clients' risks are becoming much more intangible as we go forward. So the insurance market has been very good at the tangible risk, but it's the intangible, I think, that is where we need to focus and spend a bit more time in the future, because that's becoming a bigger asset almost to our clients in the tangible side. And I think that falls quite nicely into, particularly the London market, where, we can think about risks that we're in that specialty field that we don't have huge amounts of data on, and that do require a little bit more thought, but also go into the subscription nature of the market so we can share new risks around. And I think particularly some of that intangible stuff lends itself to that subscription market. And then particularly that, again, thinking about London, where you've got underwriters, you've got claims experts, you've got legal experts, you've got finance experts, you've got analytics and portfolio management. Bringing that all together means that some of these more nebulous risks that are quite hard for people to get their head around hopefully become easier to break down, and we can produce products and new products going forward. And I mean, cyber is a classic. If we go back 20 years, probably people thought that we can't insure that, but look where we are now. It's a massive growing market, with plenty of capacity into it. So even though the market is transitioning and rates are potentially getting a little bit softer in things, it's off the back of great profitability, and there's still great adequacy, I think, in the market. It's thinking about what's next for our clients, and how do we as a market evolve to be able to serve them as they think about their future risks. And I think that's what's exciting about insurance is you can think about what is the future holding, and how do we kind of provide more certainty to our clients as we go forward.
I love that. That's a really nice take. When a market softens, so much of the focus is on the rate change for the existing portfolio. But if you take a zoom out to the world, one of the phrases that we use at HX is the world is creating new risks faster than we've got the capacity to absorb it, right? So if we can create new products, we can use it. That's a big motivator for us at HX, create better technology to enable the people creating those products to go and actually create risk capturing mechanisms. And like ultimately there's more opportunity for the market and a better result for clients, right? And your cyber example is such a good one, right? It's amazing to think that 20 years ago, people were like, this is impossible, right? It's such a need. There's such a need for cyber coverage, irrespective of it's clearly a divisive class, right? In terms of rate adequacy, the silent risks, all of that side. But there's no doubt that the market's asking for it. So the people who work out how to say yes will have a big opportunity.
Yeah, and even when we think about when we think about the demand for specialty insurance, it's still in terms of the insurance penetration is still quite low, particularly in certain areas. And I think as people see the uncertainty around them and recognize there are even existing products that they can have access to, being able to, get them to see that actually how insurance can bring that certainty to them and help them through that. Even within an existing books of business, there's still a lot more we can do. And that insurance penetration is still relatively low when you look across, even mature markets, frankly.
Yeah, absolutely. And, there's that phrase that the gap there is the opportunity, right?
Yeah. And as I think about what we're doing at Markel, so, I mean, our our vision of the next 5 years is putting Markel on the map. And part of that is all about how do we take our specialty products that we have around the group and push them out into the markets that we serve. And that's where we're going to get a lot of our lift over the next 5 years is recognizing we've got a wide experience, a wide product shelf. We don't do it in all the territories we're in at the moment, but there's the opportunity to push that. And, you know, we've got some big ambitious plans to double the business. And a lot of it is around just increasing that product shelf to our customer base.
That's wonderful. Well, look, that's a wonderful place, I think, to wrap up. Andrew, thank you. Thank you for your support. Thank you for supporting the podcast. And again, thanks for coming on the show.
Amrit, it's great to speak to you, and thanks for inviting me, and look forward to catching up sometime soon as well.
Great. That's it for this episode of the Underwriting Intelligence Podcast. I hope you found it useful and thought-provoking. If you did, don't forget to follow or subscribe wherever you get your podcasts. And if you know someone in insurance who'd find this valuable, please share it with them. I'm Amrit, and I'll be back in 2 weeks with more insights that matter in the insurance world. Until then, thanks for listening.